Okay, let's take a look at some accounting transactions related to notes receivable. And this one comes from problem 9-5A. And these transactions relate to the old company with the funny spelling. Let me split the screen so we have a little bit of room to work here, so you can watch as we work through this. Okay, so why don't we just start right here. I'll slide this down a little bit. Now, that's probably good enough. Okay, so our first transaction is on December 16th. So let's put in December 16th of year XX. And we accepted a 9,600 60-day 9% note dated today to Todd Duke, giving him a time extension on his past due accounts receivable. Okay, well, we are recording a notes receivable, and it would be related to T. Duke. So if we have a subsidiary ledger for notes receivable, we'd also record it specifically to Todd Duke, and the dollar amount is the $9,600, right? Okay, so once we have that, we know the debit and credit. The credit is going to go to accounts receivable because we're now taking it out of accounts receivable and moving it into notes receivable. So let's indent that, and then we need to give this transaction a description, and it would be to record notes receivable on account. Okay, so we'll indent that so that's also in proper format. Alright, then on December 31st, we need to make an adjusting entry to record the accrued interest on this note. So 12/31 of that year, we know we need to record an interest receivable. We're not getting paid. This is just the adjustment. And we need to record that interest revenue on it as well. I'll slide this over, indent, and to record interest earned. Okay, I probably indented one too far. Well, what's the dollar amount? Well, the dollar amount is going to be equal to $9,600 times the 9% given in the December 16th transaction, given in the problem. 9%. And then we need to figure out what fraction of the year this is for. Well, it's really for 15 days out of 360. Usually 360 is the proper days in the year. Once we have that, we know the dollar amount is $36. We record that, and we've taken care of the second transaction. Now we move to February 14th of 05. I'll put an X5 in there to put in the year. Oh, actually, they give us the full year, so all of these could be stated proper form. Okay, so on February 14th, we received payment of principal and interest for the note we've been discussing. Well, if he's going to pay it, we need to calculate how much he's going to pay, and to come up with that. Okay, before we figure out the cash amount, let's put the various pieces in that we know we need to have. We need to record some interest revenue. We need to record some interest receivable. And then we need to reduce the notes receivable since he's paying it in full. Okay, so we know that the full note that he's paying in full is the $9,600. The interest receivable was the amount we already recorded. Now we just need to calculate how much was the extra interest earned that we've yet to record. That would be $9,600 times 9%, 45 days divided by 360. That's the amount of the days we've yet to record. It's $108. So the total amount that we will collect is these three amounts. And that all balances. Now let's put it in proper form. And now let's list our note, our description of what this is for. Okay, and that takes care of our entry through February 14th. Okay, now let's tackle the March 2nd transaction, which is we accept a $4,120 8% 90-day note dated today and granting another time extension on a past-due account from the Mayor Company. Okay, why don't we slide up a little bit so we have a little bit room to see where we're at. So we are on March 2nd of 2005 on this transaction, and we accept a note, so that means we need to debit notes receivable from the Mayor Company, and the amount is $4,120, and again, we're taking it out of accounts receivable with the subsidiary accounts receivable of the Mayor Company. Okay. Let's put all these in the proper format. Probably indented enough, and now we will say to record note received on account. And indent that the proper amount. Okay, that takes care of our March 2nd transaction. What happens on March 17th? On March 17th, we accept a $2,400 30-day 7% from Jolene Halam. Again, another time extension. Well, these are essentially the same transactions. Let's just copy these, change the names. And fill in the proper amounts. This one's $2,400, right? Yep. Okay, then on April 16th, Halam dishonors her note when presented for payment. Let's slide down and cover that one. So we are on April 16th. And the first thing we want to do is, since the note is was dishonored, we want to put it back into accounts receivable. And we would probably record the interest revenue earned. And we need to take out the notes receivable, since we're putting it back into accounts receivable, taking it from accounts receivable, and that amount is a little bit more than the $2,400. We're going to take out the $2,400, but we need to record the interest revenue on it, and the interest revenue is $2,400 times 7%, right? 7% note, and it was just a 30-day note, so times 30 days divided by 360 gives us $14, and therefore the accounts receivable is really equal to the original amount owed plus the interest revenue, because this customer doesn't get off the hook for what they owe us, and we need to give it some kind of description for this entry. So to record the record the receivable for a dishonored note plus the interest. June 2nd, let's slide this down, maybe we can read a little bit more. On June 2nd, Mayor Company refused to pay the note that was due the old company on May 31st. Let me slide a little bit more, and we need to prepare the journal entry to charge the dishonored note. Let's slide this up so we have some room to work. Okay, so now we have the same thing, if you will, going on with the Mayor Company. So I can just copy all of this. Oh, and by the way, this one I probably would want to indicate that that's also for this particular note if there's a subsidiary system for notes receivable, which means in this one I've got to put in the Mayor Company. Okay, so what was the dollar amount of the Mayor Company? It was $41.20. We need to record the interest revenue on that, and that would be equal to the $41.20 times 8% times 90-day. It was a 90-day note divided by 360 gets us our interest calculation, and then therefore that formula should line up just fine. And we've recorded the accounts receivable, putting it back on the books for what was originally owed for whatever we sold, and